Navigating the intricacies of the tax system can be challenging, especially when terms like tax deduction and tax credit are frequently used. Understanding the differences between these two tax benefits is crucial for maximizing your potential savings. This video will clarify what tax deductions and tax credits are, how they work, and which might be more beneficial in different scenarios. What is a tax deduction? A tax deduction reduces the amount of your income that is subject to tax. In other words, deductions lower your taxable income, which can, in turn, lower the amount of tax you owe. Tax deductions can be either standard or itemized. 1. Standard deduction. This is a fixed dollar amount that reduces the income you're taxed on. For the tax year 2024, the standard deduction amounts are $13,850 for single filers and married individuals filing separately, $27,700 for married couples filing jointly, $20,800 for heads of household. 2. Itemized deductions. These are specific expenses that you can deduct from your taxable income, such as mortgage interest, state and local taxes, and medical expenses. You can choose to itemize if your total deductions are more than the standard deduction. What is a tax credit? A tax credit directly reduces the amount of tax you owe dollar for dollar. Unlike deductions which only reduce your taxable income, credits reduce your actual tax bill. Tax credits come in two main types. First, we have non-refundable tax credits. These can reduce your tax liability to zero, but not below zero. For instance, if your tax owed is $500 and you have a $1,000 non-refundable credit, you will only use $500 of the credit. Second, we have refundable tax credits. These can reduce your tax liability to below zero, resulting in a refund. So, if your tax owed is $500 and you have a $1,000 refundable credit, you will receive a $500 refund. Key differences between tax deductions and tax credits. First, let's talk about the impact on taxes. A tax deduction lowers your taxable income, which indirectly reduces your tax bill. On the other hand, a tax credit directly lowers your tax bill, often providing a greater benefit. Next, we have the calculation. A tax deduction is applied before calculating your final tax bill. In contrast, a tax credit is applied after calculating your final tax bill. Finally, let's look at the types. Tax deductions can be either standard or itemized. Tax credits, however, can be refundable or non-refundable. Which is more beneficial? The benefit of a tax deduction versus a tax credit really depends on your individual tax situation. Generally, a tax credit is more valuable than a tax deduction of the same amount because it directly reduces your tax liability. For example, a $1,000 tax credit will reduce your tax bill by $1,000, whereas a $1,000 tax deduction will only reduce your taxable income by $1,000. If you're in the 22% tax bracket, that deduction only saves you $220 in taxes. Practical scenarios. First, lower-income taxpayers may benefit more from refundable tax credits, as they can receive a refund even if their tax liability is zero. Next, higher-income taxpayers may find itemized deductions beneficial if they have significant deductible expenses that exceed the standard deduction amount. Conclusion: understanding the differences between tax deductions and tax credits is essential for effective tax planning. While both can reduce your tax liability, credits often provide a greater benefit as they directly reduce the amount of tax you owe. Evaluating your individual financial situation and potentially consulting with a tax professional can help you make the most of these tax benefits.